Hi, everybody. Welcome to the YouTube channel. Thanks for taking a look today. Today is January 31st, 2019, and what we're going to do is parse out pieces of the event we held today into manageable chunks and get them up here on the YouTube page so everybody can watch them in order. If anybody wants copies of the files that we're going to be using, just request them from me. I'll put my email address in the description section here on YouTube. We'll be happy to send you everything you need to get started. All we ask is you have a demo or a live account with us here at Infinity. All right, it's January 31st. My name is Patrick Zielbauer. I'm an AP or Associated Person of Infinity Futures since 2004. Let's get into it. Okay, first, trading futures. Options on futures and retail off exchange foreign currency transactions involve substantial risk of loss and is not suitable for all investors. You should carefully consider whether trading is suitable for you in light of your circumstances, knowledge, and financial resources. You may lose all or more of your initial investment. Opinions, market data, and recommendations are subject to change at any time. Past performance is not indicative of future results. Okay, just a brief introduction. For those of you who are unfamiliar with me or with Infinity, I've been registered with Infinity since the summer of 2004 at age 21. I do like to mention that because, like me, there are a number of other reps who have worked for Infinity for a very, very long time. I think it's a great representation of the stability of the firm. There's many people who've worked here for 6, 7, 10, 15 years. There are people who are working here now that have worked here longer than I have as well. There's a lot of turnover in our business. I believe this is valuable for people to understand the kind of firm we are, and I always like to make mention of that. My history, I've introduced accounts to numerous FCMs while working for Infinity. I've used and supported numerous different trading platforms, data feeds, order routing tech, all kinds of different risk systems, and I'm currently a point of contact to traders of all kinds in various countries all around the globe. Today's game plan is we're going to do a little quick discussion of pricing and margin because we always get questions about that, especially when there's new folks looking at the videos or the live events. We're going to introduce some general themes and then explore charts and do some examples. A couple things to note. One thing I want everybody to be able to do is safely let your guard down a little bit. Okay, there's no indicators for sale here. There's nothing to sell at the end of the presentation about, put your credit card here or there. Of course, if you're a prospective client, we would love for you to trade with Infinity Futures, and hopefully we can make a strong case for why you should be able to or should want to do that. But this is going to be informative. If you want copies of any of the charts we show, as I mentioned, just send me an email. My email address is just pz@infinityfutures.com, and we'll send them to you. All we ask is that you either have a live account with us or an active Infinity AT demo. Okay, so quick note about pricing and margin because this does come up quite a bit. If you have an account with Infinity, we will give you Sierra through our program free with 10 round trips every 30 days. Okay, it is the highest level of Sierra. It includes the profile and the numbers bars and all that stuff. And if you elect to use it, it is optional, but if you do elect to use it and you don't do the 10 round trips, then we will charge $19.95 at the conclusion of that 30-day period. So it's still an excellent deal. It's still cheaper than Sierra going direct, so to speak. If you were to go to Sierra's website and put your credit card in and pay for the charting, you're going to pay more than this 19.95, possibly a lot more, depending on what you purchase from them. But if you do it through Infinity, you'll get far better support, we believe, than if you get it with any through any other place or through Sierra directly. And B, you might get it for free. Okay. I would like to make note, we put a significant amount of effort into supporting Sierra. It is not a side project for us. It is all encompassing. It's all we support. So we believe that if you're going to use Sierra and you want to trade futures, there is absolutely no better place for you to trade than Infinity. And hopefully we can demonstrate that, like I mentioned. Margins, $500 margins on the E-minis, $1,000 on gold and crude. Just make sure you be aware and stay aware. Lower margins means higher risk or higher leverage potentially. So use caution, okay, especially in this kind of environment. And I would like to make note that these margins have not increased during recent volatility, which is obviously heightened, extreme in some cases. Infinity focuses on futures. It's not a side project for us. Typically, what you'll find is when you work with a firm whose focus is on something other than futures, but they offer futures, like if they're a stockbroker where most of their business is stocks or options and they're just kind of offering futures on the side, typically these companies will be much less flexible. Again, all of our personnel, our tech, our procedures, It's all geared towards futures trading. So we are a little bit more comfortable with keeping the margins low even when things are moving. The general theme of the chart setups you're going to see today: cleanliness, reducing decision fatigue, removing or hiding what is not critical, accounting for recent volatility, appreciate the context and intermarket relationships, and encourage reduced frequency of trade. So the first two of these are pretty much directly linked to each other. I'm a firm believer that decision fatigue with respect to trading is a real thing, and I think the chart should look clean. I think that if there's obviously too much clutter, like if someone who is not really actively traded before were to look at the chart and be like, "Whoa, my God, how do you keep an eye on all, or what do you make sense of all that, or how do you?" That to me is a problem. I think that what happens with a lot of self-directed intraday traders is their brain is fried by 10:30 in the morning and or earlier, and I think your ability to make quality decisions as time goes on is actually reduced. And I think that one of the things that speeds that up are all the distractions, all the data coming our way, the chat rooms, videos, and Twitter, and everything that's getting slammed in your face, all this information. I think that there are great ways using Sierra to remove or hide data points that are not critical. So in other words, there might be 4 or 5 or 6 things that need to line up before you get into a position or even get close to getting into a position or out of one. And what we can do a lot of times with Sierra is we can make an alert or a visual notification when those conditions are true. If it doesn't, if it's not required for you to see the individual components of the condition, if you don't really care that much, why do we have to look at them on 5 different time frames, on 15 different markets, and all over your screens? Why not just display the end result? That is going to be sort of the theme. All right, accounting for recent volatility. The general idea that I'm going to push here a little bit is directly related to accounting for recent volatility in your strategy. We'll talk about that. And then we want to appreciate the context and intermarket relationships. So sometimes people ask me, well, if you have this idea, why don't you just automate it? And I think it's really important to understand context. And there are situations where a signal might be valid technically, but there are outside fundamental or even possibly technical reasons why one should avoid a position. So I'm going to try to give some examples of that. Intermarket relationships, I think, are very important. We're going to talk about that as well. And lastly, and probably most paramount, encouraging the reduced frequency of trades. Sometimes people are a little puzzled by this idea since we're a brokerage company that makes money on commissions, but we're in this for the long haul. And if we take a year or 2 years to form a relationship with someone. And for many of you watching this video who are already clients, this might be the case with you. That is a lot of effort for both of us, for us and for you. And if somebody opens an account after checking us out and kicking the tires and getting to know their representative for a year or 2 years, and then they come in and they light up their account and overtrade and they're gone in a month, that does not really do us any good, and it doesn't do you any good. We would like to see people stick around, refer their friends, see success, and one of the ways we think we can do that is by encouraging people to find strategies that allow them to reduce the frequency with which they trade. Because every time you take a trade, that's one more opportunity to make a very human mistake. It doesn't mean you don't have to trade at all, obviously, but there are ways you can filter out a lot of the noise between the sort of extreme levels we're going to be talking about today. Okay, so that's kind of what we're looking at. We'll come back to this slide here in a little bit, but what I'd like to do just very briefly is give you a quick overview of the chart, and then we're going to go to the next video and talk about some specifics. Okay, now when I look at this screen here, this to me looks like too much. This is not something typically I'm looking at the entire day. Kind of goes against what I just said about cleanliness and what were you talking about, Patrick? You said you were going to show us some nice clean charts. This really is not it. But I would like to show you how we kind of get here and how we can clean this up in a way that can make the charts a little easier to follow throughout the day without having your brain fried again by 9 a.m. If you look at the markets here, S&P, NASDAQ, Dow, Russell, that's the 4 indexes that make up a very large percentage of our trade volume. Crude oil, also very important to us as a firm, and then gold and the yen. We don't do that much trading in the yen, but the yen has certain inverse relationships with the stock market a lot of the time. And so a lot of the setups that we find may work in the indexes may also work in the yen. So that's the reason I have that here. That relationship, which is kind of like a textbook relationship, isn't always the case. That relationship strength comes and goes from time to time. You have to be nimble and be aware of that. But we do like to test things out on the yen as well. One thing I'll also mention too is there's going to be some auto trading ideas here. I'm going to refer to the idea, these trade ideas. This stuff is all hypothetical. This is a simulator. Nothing here is executed in a live account. I want to be clear about that, crystal clear that this is all simulated. Okay. Okay. So what I'm going to do is I'm actually going to flip to a sort of cleaner version of what we see here that focuses on one market just so we can compare the two. And I'm going to flip over to this chart book here that says 131.19 compare in it. And we'll talk about what we're seeing on the left and on the right. Okay, so on the left-hand side, we've got these kind of curvy lines, which you can also see on the right-hand chart. We've got a bunch of other levels, value area high. We've got a overnight high, previous day's high, value area low. There's a first 30-minute high. There's a first 30-minute low down here that's kind of hidden. The overnight low, and then these wavy lines here, which we're going to refer to as MPDs. All right, we'll get to that in just a second. There's also a couple of volume profiles. One's daily, one's weekly. There's a CCI down here. There's also a tick, like an NYSE tick indicator, and then an overlay with some other different markets. So what I'm going to get to in a minute is why this stuff is present and how you can add and remove these sorts of things from your chart and why you might want to be looking at some of these things. But first, on the right-hand side, let's focus on what I'm really going to call is sort of like the backbone of this idea. Okay? On the right-hand side, you're going to see this black line in the middle, which is what's called the volume weighted average price, VWAP. So how many people here have heard that term before? Probably a lot of you. Okay, VWAP is basically a level that a lot of traders use as kind of a centering point for the market because it is a volume weighted average price. So if a lot of contracts trade at a certain price, goes into this calculation. If not a lot of contracts trade at a certain price, that is added into the calculation. And essentially what you're looking at is a line that a lot of people kind of see as a magnet. Okay, a lot of times you see the market trading around the VWAP. Okay, and that becomes the focus of the idea. What these other lines represent are the following. This line up here, which is the upper MPD, or maximum permissible deviation. Okay, that is a statistical term. Google it. In the context of trading, it's used by a lot of different people. I've actually heard it being used by more than one person in the education space. I found it all over the place when I started searching. And it's actually a concept that's been around for quite a while. But basically what you do is you take the range of the entire day, cut it in half, and then add it to the VWAP. So if the range of the day were 20 points, you would take 20 divided by 2, which is 10, and you would add 10 to this value here, and that would yield this, whatever this number is, this level is up here. All right, down here, it's the opposite, okay? You take the VWAP and you subtract half of the day's range. So the reason why this is useful, in my opinion, is because you're really taking into account the range or the volatility of the session. One of the things I like about this idea is that it's not a moving average that is like a 20-day moving average, where what happened yesterday and the day before and the day before that is something you're paying attention to. I have noticed lately that each of these trading sessions can be so incredibly unique because of the extreme volatility we're seeing. The levels that typically people are looking at, the 61.8 retracement and this and that, they just get ripped right through. It's like no one cares. So what I have decided to do is I started to look at trade ideas that were directly based on ranges. So if the range of the day is very wide, these bands are very wide. If the range of the day is very narrow, the bands are very narrow. And what I have seen a lot of the time is that by the time the market reaches one of these upper bands or the lower bands, there's a pretty good chance that it's getting kind of exhausted by that time. That is the whole idea behind this presentation, is that if you are using these bands as potential entries, these are typically counter trend style trades. There are opportunities for pullback style trend trades as well. Okay, and I'll explain kind of what I'm getting, when that might be coming into play. But what I have seen is that if the market makes, especially a kind of a quick dramatic move like this, a lot of times you see the market pull back after that. Now, what is the risk? Okay, the risk is that the market rallies, it goes through this upper MPD line, you cover your eyes and go short, and then it just keeps running and you never cover it, and you try to add your way out of the position, and you end up blowing up your account because you've been averaging it as the market's screaming higher. Okay, that's your risk. If you don't feel like you're going to be able to stop yourself out in a counter trend sort of environment, then this is not going to be for you. All right, that's obviously something you have to contend with yourself. You have to be able to take yourself out if you're just dead wrong. There are some things that I have seen that I believe can help you avoid those sorts of situations. Some are fundamental, some are related to the other markets. We're going to address it as well. But the whole idea here again is that by the time the market makes one of these moves into the MPD, especially if it is relatively dramatic, it tends to get tired up in this area. Okay, this is live data, so this is sort of what happened today. I mean, in the S&P, you can see that the market rallied really hard. I remember it was rallying really hard this morning, and then obviously it's died down a little bit. There's definitely an opportunity for like a counter trend trade in this example. All right. Conversely, if the market is coming lower and it goes all the way down to the lower MPD, then you may be looking for a potential long. Now, why am I sort of pitching this counter trend idea? Well, I personally have trouble with trend following. That's just a personal weakness of mine that I haven't yet fixed. A lot of my clients are in the same boat. I find myself gravitating more towards trying to catch a falling knife. Okay, so that's a terrible habit. Okay, but I believe there are circumstances in which it can be it can actually be a risk-adjusted strategy, but it takes a lot of patience because these moves don't happen that much. Now, if you're looking at 4 or 5 or 6 markets every day, like I am and a lot of my clients are, you might find significant numbers of opportunities. But this is kind of ties back to what I said earlier about reducing trade frequency. You're waiting a lot of the time. Now, one way to speed up the entries, I added this midline here. So this is basically a quarter of the day's range subtracted from the VWAP, and then a quarter of the day's range added to the VWAP. Okay, so it's actually a zero point 0.5 MPD, and this is like the full MPD. So if people have maybe a little deeper pockets, or they don't mind scaling into positions, or they're okay with a little bit of extra risk, they could use these values as entries. Like for example, in this area here, if somebody would have seen this market falling into the zero point 0.5 MPD, they may have wanted to take a long there. That's probably not something I would have done personally. I don't think a lot of my clients would have if they were looking at this strategy. But if somebody were a little bit more aggressive, or if they had enough capital to be able to scale into a position intelligently, then then they could afford to maybe take a little bit of heat on this. All right, but that's the general idea. So what happens then is we sort of have to think about what are the filters? Like what happens after this? And what other things are we looking at to try to avoid a potential mistake? And I'm going to cover a lot of that though. I'm going to cover a lot of that and do some examples. But before we do, we're going to end this video, and I'm going to show you in the next video how to actually create these sorts of studies using the arithmetic studies present in Sierra. So we're going to get to that in just a second. Watch that one, and then we're going to move on into some more of the trade ideas. Thanks for watching.